welcome back to the channel. We're going to go over how much income is needed in different cities around Canada to afford a house. As of right now, we got a nice chart report from, I believe, RateHub. So I'm going to kind of go over that a little bit and we can kind of see what are the differences in the major cities compared to last year in terms of how much income you really need to buy right now. And that includes stress tests, rates, everything that's kind of happened over the last year with the changing market, right? It feels very dynamic. Things are changing so much. So I think this is good information for people to just know how much money you would need right now in general to afford this in terms of your income. So buying a home in Canada became more challenging in May as rising property values offset the flat mortgage rates that we've seen. So the study calculated minimum annual income required to purchase an average home. Affordability worsened in 11 of the 13 markets studied compared to April, despite the average 5-year mortgage rate remaining fairly flat around 5.49%. The largest income increases needed, here they are. Hamilton, buyers need an additional about $1,500 in income compared to April to afford the average home priced around $868,300. In Victoria, BC, buyers require about $1,200 more in income. Now, we have some improvements in affordability in a city that it's kind of confusing, but in Toronto. So the average home price dipped about $5,900. A little bit of less income you need to buy in Toronto compared to a year ago. And I mean, it makes sense because prices have dropped and then rates have kind of been around the same spot, right? The stress test remains elevated around 7.49%. Okay, so it makes it more difficult to afford. It gives more of a challenge for new home buyers to come in. That stress test is kind of a pain in the ass, right? 7.49%. It's a pretty high amount. According to RateHub.ca, lower mortgage rates could potentially heat up home prices further in coming months. So we'll, stay tuned for that. And then the other key takeaways I wanted to talk about, where we do have some comments from the Bank of Canada that says the cut to its benchmark interest rate from 5% to 4.75, that 25 basis point cut that we had in the June meeting. They do think that this cut could actually overheat the market again. Okay, so while inflation is trending lower, the bank acknowledged risk to future inflation and economic growth, including an overheated housing market, which drives up prices, reigniting inflationary pressures. So they're worried that inflation could actually heat up again. Okay, there's always that potential. We may start to see that inflation bump up. All we can do is wait and see. In my personal opinion, what I think is going to happen, there's always the chance of that happening, but I do think things will heat up a bit, but I don't think inflation will go crazy. And again, I could be wrong, so we just have to wait and see. Around 80% of outstanding mortgages as of March 2022 will be up for renewal by end of 2024, and higher mortgage payments could curb that consumer spending, right? Because, when people renew, they're going to stop spending as much. So that could actually help drive inflation down further, okay? Because when people stop spending on other things, inflation tends to go down. And then there's possibilities of getting deflation, which is, or people say it's even worse than inflation, but we're not going to get into that now. Consumption could rebound more than anticipated if consumer confidence recovers, while strong wage growth and weak productivity pose upside risks to inflation. Now it says here, according to Oxford Economics, the policy rate could fall to 2.25% by late 2026. Okay, this is in a couple of years from now. If a modest recession hits, but we may need to stay higher for longer if the economy avoids a downturn and wage growth remains elevated. So they're taking into account all of these different things. Okay, they're looking at wage growth, they're looking at inflation, they're looking at if an actual recession hits. And I think we're still kind of straddling that line of like, people think we're in a recession right now, but are we really, right? I think we'll really know after the fact. It kind of does feel like we're in one, because I think it does seem like things are very tight for people. These interest rates are really affecting people. I think it's really going to hit next year just because of these mortgage rates, right? People who are fixed in at lower mortgage rates, once they renew, it could put a big strain on their spending and other things. And then if they're not spending in other things, let's say they're not buying TVs and cars and all the other things people spend money on, that is what can turn it into a recession, right? Because then those businesses aren't making money, then they have to lay people off, and it's like a domino effect. We kind of just have to wait and see, right? I'm just reporting what I'm seeing to you guys. I'd love to hear what you guys have to say. If you guys have any questions about just affordability, if you want to look at what you can qualify for right now in the market, no matter where you are in Canada, please reach out to me. I'll have all my info down below. If you guys enjoyed this, please like and subscribe, because if you like this video, it really helps me get this video in front of more people who could enjoy this kind of content. So I really appreciate it, and I will see you guys in the next video. Take care.